Hello, in this video, we're focusing on the practical concepts that you can actually apply in the real business world. Hope you enjoy it. Let's get on with it. Welcome, and thank you for joining today. We're going to walk through a practical checklist designed to help you prepare for securing the best possible funding. Whether you're new to investment or looking to strengthen your approach, this guide will cover key steps to make sure you're ready to succeed. Let's get started. Every year, thousands of businesses look for investment, but only a small number actually succeed. Many people think that getting funding depends on how you perform in the pitch room, like your charisma, your slides, or how you negotiate valuation. However, most investment decisions are made well before that moment. Investors start forming opinions quietly during internal discussions that focus on one key question: is this business truly investable? Understanding this early process is crucial for anyone seeking funding. Investment readiness goes beyond just having ambition or a great growth idea. It's really about showing investors that your business is credible, clear in its goals, well prepared, and able to reduce risks for those putting money in. Investors aren't just buying an idea. They want to see a business that can withstand tough questions, use funds wisely, and generate strong returns. This presentation offers a practical checklist to help you get fully ready for investment, covering why being prepared is crucial, how to build readiness step by step, what you need to have in a professional data room, along with examples of both success and failure in the real world. We'll also look at the pros and cons of being completely ready and encourage founders to think differently about fundraising to increase their chances of success. Being investment ready means building a business that stands on a solid foundation in several key areas. It's about having a clear strategy that makes sense, financials that are transparent and understandable, operations that are well managed, legal structures that are sound, and the ability to grow without losing control. When these elements are in place, funding naturally follows as a consequence, not a primary goal. This approach challenges leadership teams to focus on creating a business that is resilient and attractive in its own right, even if external investment never comes through. This discipline of preparing thoroughly improves overall business outcomes and reduces risks, making the company stronger no matter what. Being investment ready helps businesses raise funds more quickly and at better terms. When a company is well prepared, the due diligence process takes less time because investors feel more confident in what they see. This higher confidence reduces the pressure on your valuation and means there are fewer tough conditions put on the deal. Investors also view the company as less risky, which lowers the risk premiums they expect. Essentially, being ready speeds everything up and improves the conditions under which you can secure investment. Since delays can sometimes kill deals, readiness helps compress timelines, making the process smoother and more likely to succeed. Being investment ready gives you real power through optionality. When your business is not ready, you often have to raise money out of necessity, which makes you dependent and weak in negotiations. But when you're prepared, you can choose when you want to raise funds, how much capital to seek, who to partner with, and the valuation terms you're willing to accept. Investors can immediately tell if a founder is desperate, and that desperation lowers confidence and bargaining power. Removing that desperation by being ready gives you control over the entire funding process, helping you secure better deals and maintain the right balance for your business's growth. Investors want to quickly grasp what your business is about and why it will succeed. To do that, you need strategic clarity. That means having a clear problem statement, knowing exactly who your target customer is, and being able to explain your value proposition in a way that stands out from competitors. Your positioning should be unique, and your growth strategy must make sense logically. It's a red flag when a business says, "We're trying everything and seeing what sticks," because it shows a lack of focus. A green flag, on the other hand, is when you can confidently say, "We know who we serve, why they buy from us, and how we plan to scale profitably." This clarity makes your business easier for investors to understand and more attractive to back, as it shows you have a coherent plan rather than a scattergun approach. The images here emphasize measurement and growth, both critical in demonstrating that your business is not just an idea, but a viable strategic venture ready for investment. When it comes to financial readiness, many businesses lose credibility quickly if their financials don't stand up to scrutiny. Investors want to see financial discipline reflected in clean, well-organized historical accounts and consistent accounting practices so they can trust the numbers. It's also important to clearly define your unit economics. That is how each part of your business contributes to revenue and costs, and to back up your projections with defensible assumptions. Showing you've thought through realistic downside scenarios demonstrates control and maturity. Investors aren't expecting flawless results, but do expect honesty, logic, and a strong grasp of your financial fundamentals. Being prepared with this kind of financial clarity helps build confidence and reduces skepticism early on in the conversation. Having a clear governance and structure is essential because it shows that your business is more than just a founder's project. It's a real company. Investors want to see clearly defined shareholding and a clean capitalization table without any undocumented equity promises. This reduces confusion and risk, which are major red flags for investors. Also, having some kind of board or advisory structure, whether formal or informal, helps demonstrate you have governance in place, and it's important to define who holds decision-making authority. If there's any dispute over ownership or ambiguity around governance, investors will likely walk away, no matter how promising the upside might be. Solid governance builds confidence and protects your investment potential. Investment amplifies how well a business executes, but it doesn't solve underlying problems. Investors look for signs that a company can absorb capital efficiently, which means having repeatable processes and measurable key performance indicators that track progress clearly. The systems in place should be scalable, allowing the business to grow 2 to 3 times its current size without falling apart. It's also important to have a deep talent pool beyond just the founders to support growth. When a business relies only on heroic efforts from a few people, adding capital actually speeds up failure rather than success. So operational readiness is about proving the company can handle growth sustainably and systematically. Investors aren't afraid of risk itself. They worry about risks that haven't been identified or managed. It's important to be aware of key risks like relying too much on a small number of customers, depending heavily on a few suppliers, facing regulatory challenges, having fragile technology systems, or being vulnerable if a key person leaves. Founders who succeed in raising investment don't just react when problems arise. They anticipate these risks and have plans in place to address them proactively. This kind of transparency and preparedness builds trust and shows investors that you understand the realities of your business and are ready to handle them. Before seeking investment, it's important for a business to be able to quickly and clearly explain its strategy. That means summarizing what you're building and why it works in under 2 minutes. Your financial records need to be clean, consistent, and verifiable so investors can trust your numbers. Ownership must be clear and properly documented to avoid any questions about who holds what. The business should also be prepared operationally to handle new capital without disruption, meaning your processes and team can scale as needed. Finally, you need to know and be ready to share the risks your business faces openly. If you can't confidently answer these points, it's a sign that more preparation is necessary before moving forward. A well-prepared data room is crucial because it reflects how seriously a business approaches investment and how competent it is in managing capital. It's where decisions get made, so every document here should be clear and professional. Key corporate and legal documents must be included, starting with the certificate of incorporation to prove the company's legal existence. You'll also need the memorandum and articles of association, which detail how the company is structured and governed. Shareholder agreements clarify relationships and rights among investors, while a fully diluted cap table shows who owns what after all potential shares are accounted for. The PSC register identifies people with significant control, adding transparency for investors. Lastly, option schemes and warrants should be documented to ensure investors understand any rights to future shares. Having these elements organized and accessible helps build trust and speeds up the deal process. When preparing financial information for the data room, it's important to include several key documents to give investors a clear and complete picture of your business's financial health. Start with historical financial statements covering the last 3 to 5 years or since the business began, as these show how the company has performed over time. Include management accounts, which provide more recent updates on your financial status between formal reporting periods. Cash flow statements are crucial as they highlight how money moves in and out of the business, revealing liquidity. You should also prepare financial projections for the next 3 to 5 years to demonstrate your expectations for growth and profitability, supported by detailed assumption models that explain how you arrived at these forecasts. Lastly, a working capital analysis will help investors understand how efficiently you manage short-term assets and liabilities, which is critical for day-to-day operations. Together, these documents build confidence that you have a thorough grasp on your finances and can communicate this clearly to potential investors. It's important to include all relevant tax and compliance documents in the data room to give investors a clear view of your business's regulatory standing. This should cover corporation tax filings, which show your business's tax payments to the government, as well as VAT filings to demonstrate how you handle value-added tax, including pay records is necessary to verify employee tax and salary deductions are managed correctly. If your business applies for research and development tax credits, those claims should also be included. Finally, disclose any ongoing disputes related to tax or compliance, as transparency here helps build trust and prevent surprises later in the investment process. Investors will want to see detailed commercial and operational information to better understand how your business runs and generates revenue. This includes customer contracts, which show the agreements you have in place and the terms that protect your revenue streams. You should also provide supplier agreements to highlight key partnerships and any dependencies. Clearly outline your pricing models so investors can see how you set prices and drive profitability. It's important to include data on your current sales pipeline to demonstrate future revenue potential, along with churn and retention metrics, which reveal how well you maintain your customer base over time. Together, these documents give a full picture of the commercial side and daily operations of your business, which helps build investor confidence. For the intellectual property and technology section of the data room, it's essential to include all documentation that proves ownership of your IP, such as patents and licenses. Investors need to see clear evidence that your technology is protected and that you have the rights to use and develop it. Providing an overview of your software architecture helps them understand how your product is built and its scalability. Lastly, having detailed data protection policies shows that you are serious about security and compliance, which is crucial for building trust and meeting regulatory standards. All these elements together help paint a comprehensive picture of the value and uniqueness of your technology assets. It's important to include details about the company's HR and management structure in the data room. This means providing the organizational chart so investors can understand the hierarchy and key roles. You should also include key employment contracts to show terms and commitments with important team members. Incentive schemes need to be clearly documented as well, since they highlight how the company motivates and retains talent. Lastly, founder service agreements are essential as they define the involvement and responsibilities of the founders, which can impact the business's stability and governance. Including all these elements helps demonstrate the strength and structure of the team behind the business. It's important to include risk and disclosures in the data room, covering key areas like litigation history, insurance coverage, regulatory compliance, and any known issues, along with how they are being managed or mitigated. These details help buyers understand potential risks and how the company handles them. While a weak data room in this area might not immediately end a deal, it gradually erodes trust and can lead to a drop in valuation. Being transparent about risks and showing clear mitigation strategies supports confidence and smoother negotiations. A B2B SaaS company looking to raise £5 million came well prepared with solid unit economics, clear evidence of strong customer retention, a tidy capitalization table, and detailed structured financial forecasts. Because of their readiness, investor confidence was high, resulting in an oversubscribed funding round. This also meant the company's valuation increased, and the fundraising timeline was shorter than expected, This example shows how being thoroughly prepared with key data and transparent information can significantly accelerate success and build trust with investors. Here's an example of a fast-growing services firm that struggled despite impressive revenue growth. They were seeking investment but came prepared with inconsistent financial numbers, informal promises around equity, and no clear analysis of customer concentration. These gaps made it hard for investors to accurately assess the risk involved. Even though the business was growing quickly, this lack of preparation and transparency raised concerns, leading investors to pass on the opportunity. This case highlights how critical it is to have consistent, well-organized data and clear documentation in place to avoid obscuring key risks and to build investor confidence. In this example, a struggling industrial company managed to become attractive to investors by focusing on three key areas. First, they cleaned up their governance, making sure leadership and decision-making were clear and accountable. Next, they took a hard look at risks, quantifying them to provide transparency about potential challenges. Finally, they developed a credible recovery plan that showed a realistic path forward. The capital was raised not because the business was flawless, but because it was honest, well-structured, and the investors could see that outcomes were manageable and controllable. This highlights how transparency and a disciplined approach can turn around even difficult situations. Being fully investment ready means you can raise funds more quickly because everything investors want to see is prepared and accessible. This readiness often leads to stronger valuations as investors have confidence in your data and plans. It also tends to attract higher quality investors who align with your vision and add more strategic value. Another important benefit is reduced dilution, since better valuations and more competitive interest can keep your ownership percentage higher. This preparedness gives you strategic confidence, enabling clearer decision-making and negotiation power. Internally, it encourages improved discipline with processes and controls that will help your business run smoothly. Importantly, this investment readiness doesn't just help you during fundraising, its benefits continue long after funding closes, supporting growth and ongoing investor relationships. The images of the handshake and corporate building underline the professional trust and business stability that come with being fully ready to attract and secure investment. These disadvantages and trade-offs aren't structural problems, but rather discipline costs that come with being fully prepared. Trying to avoid them doesn't actually reduce the risks you face, it just hides them, which can cause bigger issues later. Preparing thoroughly takes a lot of time and effort, and it can pull management's attention away from running the business day to day. It also means being more transparent with investors, which can feel uncomfortable, especially when it forces you to confront and address weaknesses in the company. But facing these challenges up front builds trust and reduces potential surprises down the line. One of the biggest mistakes in fundraising is treating it like a straightforward sales process where you just pitch and expect a quick yes. Overly optimistic projections can also hurt credibility, as investors want realistic, data-backed forecasts. Poorly structured equity creates confusion and misalignment among stakeholders, which can scare off investors. Waiting until the last minute to prepare data rooms often results in disorganized due diligence, reducing trust. Responding defensively to investor questions makes it seem like you're hiding something, rather than being transparent and collaborative. Finally, mixing storytelling with strategy can lead to a compelling narrative but not a solid plan, which investors rely on. Ultimately, funding fails when hope replaces thorough preparation and honest engagement. Raising capital successfully doesn't start when you prepare a pitch deck or enter a funding round. It begins well before that, often months or even years earlier, when leadership commits to building a business that can stand up to scrutiny, deploy capital wisely, and gain trust. Being investment ready is not just about checking off administrative tasks. It's a strategic approach that helps ensure your business is solid and well prepared internally. Companies that raise money easily tend to look ready long before they ask for funding because they focused on building sustainable practices and clear strategies. Smart founders realize that funding isn't something to chase after impulsively. Instead, it's something you qualify for by demonstrating readiness, transparency, and discipline. This mindset is what separates businesses that attract good investors and strong valuations from those that struggle with fundraising under pressure. If you found this video useful, there's plenty of more business and finance videos on the channel that you'll enjoy watching and get great practical value from. In the meantime, thanks for watching.